Caroline, perhaps you could tell us a bit more about that.
Thank you, and good afternoon, everyone. In terms of the Romanian experience, I think it is a very good model for what some of the Western Europeans could achieve. By way of background, Romania turned to the IMF in early 2009, a little bit after Hungary. It was one of the biggest programs in the fund's history, and the program continued for 2 years, was successfully completed, and now they've moved on to a successor arrangement. They don't draw down the funding anymore, but they still have this backstop in place. One of the key lessons, I think, from the Romanian experience is that the government really took ownership of this program. Romania never had a solvency problem. Debt to GDP was around 20% when the program was first signed. It was really a liquidity issue. Romania could have treated it as very sort of short-termist in nature, but they didn't do that at all. There was a lot of political noise across the 3 years they've been with the IMF, but there was always broad support across the country, so very much in contrast to what you see in some of Europe. And one key thing was that they addressed the problems very quickly. The fiscal situation in Romania was very pro-cyclical in 2007, 2008, and when Romania turned to the IMF and EU, it was very clear they needed to rein in the public sector wage bill, they needed to rein in the pension bill, and they did it without any delay. When it became clear about a year later that it wasn't enough, again they took the needed action. There was a large VAT hike, a large wage cut. These measures were already, it was very unpopular, the economy was already doing pretty badly, but yet the government stuck to it, and it's been a very commendable effort. And the track record of policy implementation in Romania has been excellent, very much in contrast to what you've seen in somewhere like Hungary. And I mean, what is the end result? Romania is now on a successor program where the focus is growth and employment. Romania is one of very few countries out there that's no longer facing a big structural fiscal adjustment. It will be a difficult year in terms of GDP growth. They had a very good year last year, but the economy is getting back on its feet. There's no big policy changes on the pipelines. We had the first dollar-denominated Eurobond issuance from Romania this year. That went very well. The US investors were very keen to receive it. They retapped it a couple of months later. And Romania got back its investment grade rating from Fitch. They're still waiting on S&P to upgrade. I don't think that will come until after the November election, but still it is on the horizon, whereas again you look at somewhere like Hungary and I don't think anyone would want to put a timeline on when they might get back their investment grade rating. So the fact that overall Romania viewed the program in very sort of long-term metrics, it did the necessary structural reform, and it's really put the country on its feet, I think, for a successful few years ahead.
Caroline, thanks very much. We may return in the discussion part at the end to the question of how much that example might be something that could be replicated elsewhere in Europe. I'd like to turn now to Simon Keano-Evans to look more broadly at the strengths of Central and Eastern European economies vis-a-vis Western Europe, and perhaps speak a bit about another example which is often held up as a way of approaching competitiveness problems even when you don't have the option of devaluation, which is the Baltic states. Simon, over to you.
Thank you, Neil. I'm usually branded as one of the most optimistic persons around, and there is a lot of optimism going around today, which is very nice, and I'm happy to hear that. I also have to highlight how much Central and Eastern Europe has done in the last few years, and this anomaly that we have on the ratings front, why Poland is still 6 notches below the AAAs, why Russia is 8 notches below the AAAs, and why Turkey, above all, is 11 notches below the AAA rated countries. If you look at the debt to GDP dynamics of all of emerging Europe, leaving Hungary aside, the picture is much better everywhere. And from an investor's point of view, as you were saying, this is very attractive. Now, Jim was mentioning why the region has, to a certain extent, become forgotten. And the main reason is essentially its closeness or proximity to the Eurozone. And this is one of the big risks at the moment that we're dealing with. We, as a house at ING, believe that Greece is going to stay in the Eurozone. This is our baseline scenario. And we believe also that this is the most important thing for the further development of the European Union. Now, emerging Europe as a whole cannot be excluded from the European context. And Poland is the largest country amongst emerging Europe new members of the European Union who joined in 2004 and 2007. From that point of view, Poland is obviously looking to have a larger say in the whole Eurozone process, although it may not be joining right away. But the ultimate goal or aim should be moving towards Eurozone accession, as it should be for all of the other countries who signed the Maastricht Treaty. And I think this will be very beneficial for Western Europe, just as it will be for Eastern Europe. Looking to Poland and the other countries, Poland, as you know, is much less exposed to the Eurozone downside, given that its export to GDP ratio is much lower, and given that it didn't do as much as other countries did in the region, some of the countries like Romania, Bulgaria, Hungary, on the foreign exchange lending side. However, Poland is still very much dependent on its exports on the EU 15. Around 60% of exports still go to the EU 15, whereas countries like South Africa and Turkey have been able to diversify away from the EU 15, dropping their total exports to the Eurozone basically by about 10% in the last 4 or 5 years. So I think the challenge for Poland in the coming years will be to actually expand and diversify its exports. And one thing I would recommend to everyone here in the audience is to look more towards Turkey, a very strong growing economy, as we've heard before. And I think that the relationships between Poland and Turkey have been actually historically very good. Now, to touch quickly on the Baltics, I think the success story in the Baltics has been that they were able to take an internal devaluation in the last few years, which Greece is not prepared to take on. And this is the one major problem at the moment with the Eurozone membership of Greece. Now, the assumption, and we've been hearing this in the last couple of weeks, is that going ahead, the model of the Baltics will be taken on by other countries. We will have to see an internal devaluation, depreciation of assets which have increased in price over the last few years quite strongly. And this includes taking hits on things like wages. This includes government austerity programs coupled with programs that benefit the EU as a whole from an infrastructure process. There is no railway network in the European Union. This is the one main problem with Romania. This is also an issue in Poland. The railway network, the roads, the motorways in Poland have to continue to be built and not just stop now because of the Euro Football Championship. And this will be one constraint on many countries' infrastructure in the future. And that's why I think that focus needs to be put from the European Union on these issues. And looking ahead, well, essentially, it's all up to Greece now, and I'll give you the floor again. Thank you.
Thanks very much indeed, Simon.